This meeting is being recorded.
All right. Hey, welcome back to Principles of Accounting 1. Still your host, Dr. B. Happy to have all of you with us today as we explore accounting information systems. Now, today is October 1st in the fall 2024 semester. Wow, holy smokes, we made it to October already. So what does that mean? Where are we in the classroom? We are currently in week 7. Week 7, okay? Why is this a big deal, you might be wondering? Because next week is the midway point. Midway point next week, week 8. So today we're going to talk about accounting information systems. You have 2 things to complete as you normally do. But this week is kind of a big deal. Why is it a big deal? We have another LinkedIn Learning Certificate. I know. Oh, Dr. B, oh my goodness, you make me work so hard. Oh, Dr. B, why do you do this to me? I'm constantly working in your class. You give me so much work to do. Why am I learning this LinkedIn learning stuff? So remember, when we first started this course, I know it's hard to remember because that was 7 weeks ago. I don't remember what happened yesterday, let alone 7 weeks ago. But I do recall us talking about this LinkedIn Learning Certificate thing, And I had mentioned that one of the reasons why these LinkedIn Learning Certificates are so important for you is because this provides you with an opportunity to demonstrate to your employer or potential employer in the future that you know this stuff. You're certified in this stuff. Okay? That's why it's a big deal. It's important to me that what I teach you in this class, and if you take Principles 2 with me, in that class, in these classes, it's important to me that you have the opportunity to take stuff with you when you leave, okay? You put it on your LinkedIn profile, you put it on your resume as a certification, because that's what it is. It's a certification. Each of these LinkedIn Learning Certificates is a certification that demonstrates to your potential employer or current employer that you know what you're doing when it comes to accounting stuff. Okay, that's why I find this very important. So we have a LinkedIn Learning Certificate for this week. This particular one is called Accounting Foundations Bookkeeping. Bookkeeping is, as the name implies, keeping the records. Okay, keeping the records. Bookkeeping involves recording the transactions, posting the transactions, going through the accounting cycle through an accounting information system. An accounting information system, as the name implies, an accounting information system is a system that contains all of the accounting data, all of the transactions, all of the financial statements, all the customer data, all of the employee data, all the wage data, all that information is housed within the accounting information system. That's why bookkeeping is an important role in accounting. With this certification, this tells your employer or future employer that you understand the concept of bookkeeping. Every business on the planet does bookkeeping. Why do you think that is? Who in the class can tell me why would a business need to do bookkeeping?
To ensure like they have the funds are being moved
Yes.
around where they need to go, bills are being paid, to keep track
Yes.
of money and
Yes.
to transactions and things of that nature.
Yes, all of that, absolutely, yes. You nailed it. Terry, I saw you on, Miss Mac, I'm sorry, I saw you on mute.
You can call me Terry, that's fine. I
Okay.
was just going to say the most important one is just to pay the employees,
Pay the employees,
pay
yes.
salaries.
Yeah.
Yes. Now, how did I forget that one?
How to pay your employees. Yes.
Yep.
Thank you so much. Yeah. It's all those things. The bookkeeping is critical to the business because how else you gonna know how much revenue you took in, how much expenses you paid out, what your cash flow looks like, what your balances look like. Otherwise, you won't know. That's why bookkeeping is so important. So that's why this particular LinkedIn Learning Certificate is really, really important for you. Because, again, you take this with you. You put this on your LinkedIn profile. You put this on your resume. This is good stuff, okay? Because you're demonstrating to your current employer or future employer, you know bookkeeping, okay? And so I'm telling you, it may not sound like, oh, Dr. B, who cares? Everyone cares because every employer requires some kind of bookkeeping. It might not be you. I mean, you might not be in this class to become an accountant. I get that. I get that. But in some way, shape, or form, whether you own your own business like Ms. Mac does, or if you're going to go into someone else's business, you got to think about this because the reality is you got to know how to do it, right? You got to know your revenue, know your expenses, know your balances, know your cash flow. Make sure your employees are paid. All those things are super critical. So that's why this LinkedIn Learning Certificate in particular is so important. So I want you to take your time with it, but you know how time goes, right? But just go through it. Try to remember all this stuff. We talked about all of this stuff, but we talked about all this stuff from, the textbook perspective and, that kind of stuff. This is more hands-on, and it just kind of deepens the knowledge, and it talks really about how everything that we learned over the past 6 weeks, how all that gets dumped into an accounting information system. So that's why this bookkeeping LinkedIn Learning Certificate is so important. So please go through that. It's super critical. So that is in your week 7 folder for Engage and Explore. Access it through Engage and Explore. You'll go through all the videos, and then you'll at the very end, you'll download your certificate, and you'll upload it to this folder here, Accounting Foundations Bookkeeping Submission. And you'll upload it, and that's it. Nice and easy. So that's the certificate. And then, of course, you have the chapter quiz related to accounting information systems, which we are about to jump into right now. So yeah, have fun with that certificate. I honestly think that it holds a lot of value. So that's why I have it in this class. It's just, again, something you take with you. So accounting information systems, as I mentioned, is a software. It's a database. It is a place for you to store all of the company's transactions through the journal entries on the ledgers and, all those really important things. It helps you to track all of your revenue and expenses represented on your income statement. It helps you to track all of your cash flows on the statement of cash flows. It helps you to track your balances on the balance sheet. And, of course, any type of retained earnings on the statement of retained earnings. So that's why, accounting information systems, that's what they are. It's a database. It houses all that information. It helps you to analyze and process it. And they're commonly used in pretty much every business. The most commonly used accounting information systems are as follows. I would say Excel is probably the most common one. You wouldn't think of Excel as being an accounting information system, but it is an information system, right? So Excel, QuickBooks is the most widely used accounting information system on the planet. Research shows that here in the United States, 82% of small businesses in America use QuickBooks as their chosen accounting information system. And that's for small and medium-sized businesses. Medium and large-sized businesses might use something like Sage or Oracle or M3. There's a couple of other ones out there, but those are the most common ones. For all intents and purposes, in this course and in Principles of Accounting 2, we try to focus on QuickBooks because it is the most commonly used among small and medium-sized businesses in the United States and around the world. So it's important that we know what type of things go into something like QuickBooks, an accounting information system. So let's take a look at the system principles and components. Accounting information system, as the name implies, collects and processes data from transactions and events, organizes them in reports, and communicates the results to the decision makers in a very simple way. So everything we input into our accounting information system, we get an output, right? The input is the transactions that we're entering in. Now, the great thing with modern technology, even with QuickBooks, is I can use my cell phone, okay? I can use my cell phone and I can grab my bill, okay? And I can record my bill as easy as taking a picture of it with my phone, open up my QuickBooks application on my phone, and it inputs all of the information for me. It tells me, who the bill is being paid to, when it needs to be paid by. It'll code it. It'll say, oh, this is a utility bill. This is the amount, etc. All that data from the bill goes right onto your QuickBooks, just as a snap of the phone, right? Easy. It's gotten really good. So in thinking about that, the accounting information system, QuickBooks, did all that for it. It brought all the information in and it organized it in a meaningful way. See? So what does it do? It is a system that helps me to identify controls within the company using the control principle, which is a system of internal controls. Remember, we talked about internal controls briefly. Internal controls are the procedures that help managers to control and monitor business activities, right? So we use accounting information system like QuickBooks for internal controls. We use it for relevance. Relevance meaning, is the information useful, understandable, timely to help the decision makers, right? That's what it means to be relevant information. We use QuickBooks for compatibility. Is this company's activities, personnel, and structure compatible, right? Is everything logical? Does it flow logically? We use it for flexibility. We have to be able to adapt to changing business environments and changing needs of the company, right? So we got to be flexible. And then, of course, we look at accounting information systems as the cost benefit. Do the benefits outweigh the costs, right? The cost benefit analysis. So we look at all these things and we make sure that our accounting information system has all of these principles, has all of these components. That's what makes a good accounting information system, like QuickBooks, for example. Now, there's some inputs that we have to do that we use in order to get our outputs, our reports. The inputs come from our source documents. Remember, we talked about source documents a long time ago. Maybe, oh my goodness, I think like maybe week 1 or 2. So that was a long time ago. As you may recall, source documents include things like bank statements, checks, invoices from our suppliers or vendors, bills, receipts, etc. Right? Employee earnings records, the pay stubs, etc. These are all source documents. And we use those source documents and we enter them into our accounting information system. How do we enter them? There's a couple different ways. One I just told you about. I can use my phone, take a snapshot of it, open up my QuickBooks app, and boom, it's in. Okay, that's one way. I can use this really old thing, this really old method. We call it a scanner. Okay, back in the early 2000s and even in the 90s, we had this thing called a scanner. I remember when these scanner things first came out, and I was like, wow, what the heck is that thing? So basically what it does is it's a way to copy or to scan into your computer, upload the document into your computer. You could scan them in, okay? Or even older. Here's an even older device. Have you ever heard of this thing called a fax machine? Okay, now now hear me out. This fax machine, wow, holy smokes, talk about old. The way it used to work was I can send somebody a document, a bill or an invoice or whatever. And this was kind of before like the internet ability to upload and scan and transmit it that way. Back in the 80s, we used to use this thing called a fax machine. And the way it worked was if I wanted to send somebody a document and they, lived further away, and I needed it there right away, instead of waiting a couple days for the mail, what I would do is I'd put it into the copier machine and I would dial the phone number of the other person's fax machine. And then you hit send, and then it would send that person the document on the other end. Okay, that's the way a fax machine worked. Today's day and age, I don't know anyone that uses one anymore. I'm sure they still exist, especially in the government contracting world, but in today's day and age, they're kind of non-existent, right? They were replaced by the scanners. And now the scanners are being replaced by the phone, right? But these are all input devices. We take that information, put it into our accounting information system. Sometimes we'd even use the keyboard, right? We have to manually enter the fields, okay? So you got your QuickBooks blank invoice open. You manually enter the date, who it's being paid to, the amount, the address, all that jazz, right? Manually enter it with a keyboard and the mouse. So all that information gets entered and then it gets processed. So we enter it into QuickBooks or some other AIS. The system processes it. It automatically applies those bills or invoices or whatever to the ledger accounts, through journal entries, etc. Okay, and then we store that information. It can be stored on a hard drive, hopefully not a hard drive. If you are storing it on a hard drive, make sure you have backup copies. I can't say that enough. The great news with modern technology is I can store everything on the cloud. right? I could store it on Google Drive or Microsoft, what the hell is it called? The cloud thing, the OneDrive. The OneDrive, the Google Cloud, the whatever cloud service, iCloud, right? You can store all your important stuff on the cloud. Why? Because if something happens to your computer, right? Computer decides to fry itself, you can't get that data back, right? It's done. It's gone. So that's every client that I ever had. I've always told them, listen, don't save stuff to your computer that's important. And I say, why? And I said, what happens when your computer dies? You can't get it. So I tell them, save it to the cloud. And then they go on to the cloud and they access that information, okay, when they need it. The great thing with QuickBooks is that there's a couple of different versions of it. Yeah, there's the desktop version. You can download it, use it on your computer. And that's fine. There's nothing wrong with that. I personally prefer the online version because I can access it from anywhere. I don't have to be sitting at my computer or have a virtual machine running. I can be at somebody else's house. I can be on the road. I can be on an airplane, in my car, whatever, and I can access my company's information straight away, right? As a decision maker, as a business owner or a decision maker or a manager, you got to be able to make snap decisions. So it's important for you to be able to have access to your financials for the company at all times. So that's why I always recommend the cloud service and have it online. So those are the components. Now I'm going to do my best to explain these journals to you and ledger accounts in a meaningful way. I want you to think about how it would work in a computer information system, in a database. So when you hear me say double click or zoom in, right, you just think about it from that perspective, okay? So when I am recording transactions, I got to know where to put them in my accounting information system. And I put them in a special way. And I do that through what we call special journals and subsidiary ledgers. So think about a transaction, right? Let's say we sold some merchandise to a customer on account. Sold some merchandise to a customer on account. So what that means is I sold some inventory to a customer on accounts receivable. Okay, they're going to pay us later, right? That requires the use of special journals when we do that. Okay, I need to post that transaction to special journals. In this case, I'm going to use my sales journal because I made a sale. I'm also going to use my accounts receivable journal or ledger because I'm also affecting accounts receivable. I'm also going to affect my inventory ledger, right? Because I'm reducing my inventory. I'm also going to affect my cost of goods sold ledger because I sold inventory, right? So remember, when we sell inventory, there's actually two transactions that happen. So that means we're going to affect 4 different journals, 4 different ledgers, you see? So a general journal is an all-purpose journal that we've recorded when we record the transaction. You already knew that. The special journal is used to record and post transactions of similar types. Most of these transactions are merchandise, are categorized in the journals that you see in front of you. Sales journal, cash receipts journal, purchases journal, cash payments journal, general journal. This seems a little old-fashioned. It kind of is. This slide, as you can tell, is kind of relatively old. So this database, this accounting database, looks like it's probably like Windows 98 version. Okay. So the interface on accounting information system today in 2024 are a lot more modern, they're a lot more interactive, and there's a lot less screens, which is kind of nice. Just give an idea of what it looks like today. But just follow me now. So the idea is that with every transaction, we're going to affect two accounts. We already know that each account represents a journal. And then, of course, within the journals, we have our subsidiary ledgers. Subsidiary ledgers stem from the parent account or the general ledger. Subsidiary ledgers are the individual accounts that have common characteristics. This includes details of information on specific accounts in the general ledger. So here we have two subsidiary ledger account examples. We have accounts receivable and accounts payable. We already know that accounts receivable means that we sold something to a customer, they haven't paid us yet. That's account receivable. Okay, so the characteristic is customer owes us money. The controlling account is account receivable. The subsidiary ledger account is account receivable ledger. Makes sense. Then, of course, we have accounts payable. That's when we, the business, owes money to somebody else. We received a bill, we haven't paid it yet. So we owe money to somebody else, that's an account payable, which means we're going to use the account payable ledger in our accounting information system. Think of these ledgers as individual accounts. Here we have an example. We got accounts receivable on the left side, accounts payable on the right side. And I also want you to think about your balance sheet when we talk about these two accounts. As you know, account receivable is a current asset account. Account payable is a current liability account. Okay? Think about how those balances are made. If my account receivable balance is $20,000, do you think it's all owed to one person or one company? No, probably not. It's probably a bunch of different bills. Okay? So here we have the example. I got 3 different companies I owe money to. Ace Manufacturing, ITT Company, and Smith Company. Those are my 3 vendors that I owe money to. I owe 20 grand. How do I know that? My general ledger total says 20 grand. Who do I owe it to? I don't know. I got to find out. I double click or zoom in on my general ledger accounts payable account. I open it up and it shows me a list of all my different vendors and the amount I owe to each one of them. Okay, listed out. You see what I'm saying? Each individual vendor I owe money to is its own subsidiary ledger. Each individual person or company that either owes me money or I owe them money is considered its own subsidiary ledger account. The subsidiaries are the children of the parent account. The parent account is the general ledger. The subsidiary ledgers are the children of that parent account, which is the general ledger. See? General ledger, that's the parent. Subsidiary ledgers, those are the children. Okay, that's a way to think about it. The children belong to the parent. All right? So that's a way to think about this, right? To help it make sense for you. On the other side, on the account receivable side, I got the total account receivable in my general ledger account. Oh, it looks like $10,000 is owed to me, the company, by my customers. who owes me money? I don't know. I got to double click and zoom in and figure out who owes me money. So I double click on my accounts receivable ledger account and it opens up. It turns out I got 3 customers that owe me money. Albert Company, Frank Booth, Jason Henry. These 3 individuals or individual companies owe us money. Okay? And the total of these 3 equal the total amount shown on the general ledger. That's what we're trying to get at. So that's how an accounting information system works. It helps to organize things in a logical way. So let's talk about sales. As I had mentioned earlier, when we sell something to a customer, either on cash or account receivable, we made the sale, but remember, a couple things happen with each sale of inventory that we make. I got to record the sale, right? I got to debit the cash or the account receivable, and I got to credit sales. That's the first part of the transaction. Second transaction is I got to debit cost of goods sold and credit inventory, right? Those 2 things have to happen for each thing that I sell. Now, there's probably nobody sitting back there and typing all this out for every transaction. That would take forever. It happens usually automatically. How? Remember the barcode thing when we talked about inventory? Every time that the barcode got scanned at Macy's, every time the customer went up to the Macy's counter, they went to go cash out, they scanned the barcode. As soon as that barcode got scanned, we recognized the sale when we took the customer's money. Took the customer's money, recognized the sale. That happens automatically. That's a part of the perpetual inventory system. It updates the accounting information system automatically. Because otherwise I can imagine someone sitting in the back of the accounting office going nuts because they're entering a transaction every second that the store makes a sale, right? So, but you see my point. It's automatic. So when you see this on your screen right here, this sales journal, it's representative of those sales. So here we go. This is the month of February. We made a bunch of sales to different customers, sometimes the same customer. And we got the sales amount. Debit sales, credit cost of goods sold. Remember? That's the second part of the transaction. I'm sorry, debit account receivable, credit cost of goods sold. What am I saying? Debit, accounts receivable, credit sales. That's what I meant to say. I'm sorry. Debit cost of goods sold, credit inventory. Right? Those are the 2 transactions that happen. So let's do the account receivable and sales side first. So every time I make a sale on account receivable, it updates my account receivable ledger, the general journal. Within that general journal, I have my subsidiary accounts. Each subsidiary is represented by an individual customer. We can see how when we debit it, the account receivable, it puts a debit in their subsidiary side of the account. So here we make our sales on account receivable. So we'll update the account receivable balance for each of our customers, each subsidiary account. On our inventory side, on our general ledger side, we take the total of all of our subsidiary ledgers and we get our total account receivable on our general ledger. In this case, $2,150 is the total. How we got that, we added up all of our subsidiary ledgers. On our inventory account, we got our total inventory that we sold, credit balance 1,500. We also have our sales general ledger, 2,150. It matches our accounts receivable sales. And we have our cost of goods sold, 1,500. Matches what we sold out of our inventory. But you see how it works, right? We have the parent account, the general ledger, and the subsidiary accounts, which represent the children. Okay. Now, oftentimes in business, we got to make sure that this stuff is correct. How do we make sure that the balances of our subsidiary accounts are accurate? It requires what we call a proving of the ledgers, or an audit of the ledgers. And what this does is it helps us to identify the balances from each customer or each vendor that either owe us money or we owe money to. Here we have an example of the account receivable ledger. We open up all the subsidiaries, we look at all of our customers, and we make sure that our total account receivable balance equals what we have in our general ledger account. And we've got to make sure that it's correct. So that's the way we verify it. Now, once in a while, we get one of those real strange transactions. And y'all remember how much I told you how I dislike returns and allowances, because it means that customers bringing stuff back to us. Right? I told you that when we talked about our inventory, remember? So here we have a return or allowance. I got a customer returning merchandise to me. So I need to make a adjusting entry. Okay? So in this case, I debit sales, returns, and allowances, 175, and I credit accounts receivable for that particular customer, 175. In this case, the customer's name is Ray Ball. Ray is returning $175 worth of inventory that they purchased from us for whatever reason. Okay, they're returning it. You'll notice the account numbers on the middle part, 414 and 106. 414 is the account number for sales, returns, and allowances. Account numbers are found on your statement, on your chart of accounts. Your chart of accounts shows your account numbers, okay? 414 is the account number for sales, returns, and allowances. 106 is the account number for accounts receivable. But more specifically, 106, 100 is account receivable. 106 is the number for this particular customer, Ray Bell. Okay, they have their own subsidiary account. So therefore, they get their own account number. 100 is account receivable. 106 is Ray Bell, a customer. You see how that works? That's why the account numbers are really important. Helps you to specifically track who owes you what and how much in your accounting information system. That's why the account numbers are so critical. Okay. So that's account receivable. I'm going to show you what it looks like with cash. Now, cash, of course, is a lot easier. Sometimes your customers will pay you in cash, and sometimes your customers will pay, well, actually, they should always pay their account receivable, right? So here we have examples of some sales we made using cash, or collecting cash, and some of our customers paying us. So when a customer is paying us their account receivable, we debit cash to recognize the increase of cash, and we credit accounts receivable to reduce the account receivable for that particular customer. Okay, so here on the left side on the account receivable ledger, the subsidiary ledgers, we see customers paying us, right, based off of their existing balances on account receivable. So Albert Company paid us $500. Jason Henry paid us $450. Paul Roth paid us $200. Okay, you see. So they're paying down their balances. And then sometimes the customer will take another purchase on account receivable, just like in the example of Albert Company and Jason Henry. But you get the point. You know, the customer is paying us what they owe us, and we're updating their totals, their particular subsidiary ledger accounts. And of course, that's also going to affect our general ledger accounts. Our cash balance is obviously going to go up because we're receiving more cash from our customers from the receipt of their receivables. The account receivable balance is going to go down based off of the receipt of cash from our customers paying their accounts off or down. Inventory goes down because we made sales in cash over the counter. And then, of course, some other things are done with cash. The business uses cash to pay certain things, like loans or other expenses. But you get the point. So based off of those cash transactions, we also need to make sure that the cash transactions are correct. So how do we do that? We go through what's called a footing, cross-footing, and posting process. Fancy word for making sure your stuff balances. Okay. So how do we make sure our cash balance is accurate? We take on the debit side, we total up our cash, discount, our sales discounts, cost of goods sold, and we get the total. So we add all those three things up. On the credit side, we add up account receivable, sales, other accounts, inventory to get the total. As long as those two balance, we can tell that our cash balance is correct. So we don't have to worry too much about any errors made there. It's just a way of verifying that it's accurate. Okay. So we talked about account receivable, we talked about cash. Now let's talk about the business side, which is how we purchase inventory and pay for inventory, that kind of thing, using what we call the purchases journal. Purchases journal represents us, the company, purchasing inventory from our vendors. That's all it shows us, yeah? That's what purchase journal means. Okay? So the way it works is that I purchase inventory from my vendors. Sometimes I do it on account payable, and sometimes I do it on cash. When I do it on account payable, what it means, I got to debit inventory to increase my inventory and credit account payable to increase my account payable. So here we have a couple of transactions I made on account payable. I purchased 6 times from 5 different vendors on accounts payable. So each time I debit inventory and credit accounts payable. Okay? And you can see, just like on the receivable side, I have my subsidiary ledger accounts, which represents each vendor that I'm purchasing from. When I total all of my different vendors up, I get my total accounts payable. Okay. In this example, total accounts payable is 1,325 is my balance. And I can see that balance on my general ledger for accounts payable. And then, of course, I might also purchase some other thing on accounts payable, like office supplies, store supplies, sometimes, But you also see what's going on with my inventory. I increased my inventory by the 1,150. Yeah. Why might that be? Because some of these other stuff I purchased was like office supplies and other things. But you see how it works, and you see how it rolls up. Remember, the parent account, those are the general ledger accounts. The subsidiary accounts roll up. The subsidiary accounts are the children that belong to the parent, the general ledger. And of course, just like before, I got to make sure that everything balances out correctly. So I add up all of my accounts payable to my different vendors to get total accounts payable. And that should represent what I owe on the general ledger to make sure it's correct. Yeah. And just as before, I would purchase on accounts payable. I also have to pay my bills, and I pay with cash, right? So I got to pay my vendors. I got to pay for the inventory I purchased on accounts payable. I got to pay that down. How do I pay that down? I pay my vendors. So here we have, I paid out $927 worth. And so, let's see here. I also returned some inventory, about $13. It was damaged. I sent it back. So I reduced my accounts payable. And in this case, I went down by $650. I also paid some employees $250. Yeah, $650 plus the $250. Minus the sales discount. And then I also paid my individual vendors, as you can see in the accounts payable subsidiary ledgers. I paid a couple of my vendors. So in order to pay a vendor, I debit the account payable, credit cash. Yeah. So you can see how it's all connected. The parent account is the general ledger. The subsidiary accounts are the individual vendors. Okay. So that just gives you an example of how it all works. And then, of course, there's some other, odd transactions that occur in business. Things like the receipt of a note receivable. A note receivable is when we have a customer that had not paid us for a while. And so we go, hey, customer, you haven't paid us in a while. It's 30 days past due, 60 days past due, 90 days past due, 120 days past due. And then I finally get a hold of the customer. I say, hey, customer, you're 120 days past due with your account. You owe me, X number of dollars. Say, listen, I'm going to convert your accounts receivable into what we call a notes receivable. A note receivable is simply a conversion of accounts receivable to notes receivable plus interest. So now I'm charging my customer interest. You see, that's what a note receivable is. So I have to make general journal entries for that. Purchase returns and allowances you already know about. Purchase of property, plant, and equipment. On notes payable. Sales returns and allowances, adjusting and closing entries. Those are all adjusting and general journal entries that I would make in my accounting information system. And remember, I usually make all of these either at the end of the year or end of the month. Think of them as like adjusting journal entries. So what kind of accounting information systems are out there? We already talked about QuickBooks to a certain degree. There's also Sage 50. It used to be called Sage 50. It's just now Sage. That's their new name. It used to be called Peachtree back in the day. QuickBooks is the most common one. And then there's other ones like Oracle and a whole bunch of other ones. FreshBooks, I think, is a newer one. There's probably 100,000 different accounting softwares out there. Most commonly used is QuickBooks. These softwares are heavily integrated, so they're integrated with a lot of different applications. For example, in business, sometimes if you have like a small business, let's say you have a business on Etsy, or let's say you have a food truck business, or you got some type of boutique business or whatever. Your business might run on QuickBooks. And you've got to figure out a way to accept credit card transactions, right? So you might hook up with Square or one of the other credit card processing companies, and that will integrate with QuickBooks. So the transactions will automatically port over into your QuickBooks, so you don't have to worry about trying to figure out what is 3% of the transaction for the processing fee or whatever, right? It's all automatic now. There's a lot of different integrations with the software. It's good. It's very good software. So the processing is automatic. As soon as it's entered in, as soon as that transaction is entered in, it's automatic. It's processed immediately. In other businesses, we do what's called batch processing. Just a curiosity, anyone ever work at a restaurant or a retail company? Ever? You ever work at a restaurant or a retail company, in your history? I have.
I worked in a restaurant before.
Okay, great. So Miss Mack worked in a restaurant before. I worked in retail before. I also worked in the hotel business before. And so batch processing is real common with these types of businesses. The way it works is throughout the business day, you'll process a lot of transactions, a lot of credit card swipes from your different customers, right?
Mm-hmm.
So at the end of the night, we go through what we call closing out our batch. What that means is when we're closing the store or we're shutting down for the night, or the night auditor's coming into the hotel or whatever, they run the batch report. And what happens is they'll select the green button on the credit card reader or whatever, or all the different credit card readers if there's multiple ones. And it'll print out what we call a Z-tape. And the Z-tape represents all the transactions that happen throughout the day. Okay, so it'll keep printing and printing, and it'll show you a total at the end. What we're doing here is we're closing that batch out. We're closing the batch out. And what that means is it'll post to the accounts. Think of it this way. If you've ever gone out to, we'll say, a restaurant or to a retail store, okay, and you used your credit card or debit card to purchase something, okay, and and later that day you go into your bank app and you're looking at it and it says processing, and you're thinking to yourself, why the hell does it say processing? And, it's been processing for a while. What the hell does that mean? And sometimes it'll be a couple of days. It'll be processing, right? It's a temporary transaction is what banks call it, I think. And you're like, why does it say this? It's because whoever processed that transaction didn't close the batch yet. When they close the batch, that's when it solidifies and it goes onto your bank account. So next time when you're out and you swipe that card, your debit card or your credit card, and you purchase whatever, go take a look at your bank application or statement. It might say processing or temporary authorization, something like that, right? That means the batch hasn't been closed out yet. When the batch is closed out at the end of the night, that's when it hits your account. So it hits your account next morning. That's what that means. In business, it's a good practice to close out the batch every single night, every day. Don't screw around. Don't wait a week. Don't wait a month. Certainly don't wait a month. Why? Because you want that money right away. That's how we run the business. A lot of larger businesses have multiple computers, as you might expect, and they're all connected to each other using the computer network. Computer network can be identified as what we call a VPN, or virtual private network. It's a way individual computers can talk directly to each other without accessing outside methods. Some companies, they do a lot of different things. Okay, they manufacture stuff, they sell stuff, they service stuff. Okay, for companies like that, they probably use what we call an enterprise resource planning software, because they have a large enterprise. They do a lot of different things. Think about John Deere, for example. I love John Deere. Think about John Deere, for example. What they do is they manufacture and sell, we'll say, lawnmowers and heavy equipment and a lot of other industrial type of machinery. Okay, agricultural products mostly, but they sell a lot of other stuff for home use, etc. John Deere's a huge company. They manufacture, sell, and service all of their machinery that they sell. Okay. So because of that, they probably use an enterprise resource planning software that helps them to speed up the decision-making process, helps them to identify opportunities to reduce costs, and it gives managers more control over the operations. Just want to tell you what it was. Common enterprise resource planning softwares include SAP and Oracle, and there's other ones out there. There are a couple of add-ons you can also get for QuickBooks. Just give me an idea. When I use my accounting information system, I like to visualize things. I'm big on visualization. Why? Because if I need to explain my financial situation to someone else, they don't understand numbers. So that's why it's for you in this course and in the next course, it's important for you to know the numbers. But it's also important for you to be able to tell the story to someone who doesn't know the numbers. So let's say you own a business and you want to get people to invest in that business. They're not going to understand income statement, balance sheet, statement of cash flows, statement of retained earnings. They don't get that stuff. Okay, they just don't. Most people don't take accounting courses. Only business students and sometimes business owners do. So, but when you talk to other people, like you talk to your friend who's a psychology student or a science student, they don't get this stuff. So we got to figure out ways to help them to understand it. The way that we do that is through charts and graphs and to make things look pretty. And through data dashboards and interactive ways through charts and graphs. It helps them to understand it. It visualizes it for them. So making things visual is really important in business. So I can't tell you how many times I've talked to CEOs, and they don't know. They barely understand how to read a profit and loss statement, or balance sheet, or statement of retained earnings, or statement of cash flows. They don't get it. They get a graph. I show them a chart. I show them a graph. They get that. They get that. They don't get the numbers. They get the charts and graphs. So it helps them to explain it to them. Everything's interconnected, as you know. Everything's based off of cloud computing. Everything we do, really, the phone, the computer, the laptop, the tablet, the whatevers. There's so many different things now. Hell, even the television, right? It's all interconnected. So everything's done through what we call cloud computing. Get everything instantaneously, and we can access it from anywhere. All right. Now, you know, it wouldn't be an accounting class if I didn't have at least one ratio for you before I let you go. So here it is. This is what we call days payable outstanding. Days payable outstanding is the average length of time that the payables are deferred until the payment is made. How long it takes us to pay it. Fancy word for saying days payable outstanding. How long it takes us to pay it, the bill, okay? How long it takes us to pay that bill. We take accounts payable balance divided by cost of goods sold times 365 days. Ideally, a good business operates on 30 days or less. 30 days or less is a good business practice. Sometimes you can negotiate with your vendors, you know, and extend it out 60 days. You know, most vendors want to be paid in 30 days or less. Here we got Costco. They're at 32 days and 32.1 days. That's how long it takes them to pay a 30-day bill. You got Walmart, 44.6 days. Yeah. So this number, it depends on how you're looking at it. As an investor, I'd be happy with 44 days. Why? Because it means they're using the cash for other stuff before they're paying the bill. But I'd be worried if I worked there when I saw something like that. That means we're taking too long to pay our bills. Depends on how you look at it. Okay. So that brought us to the end of our conversation today on accounting information systems. As a reminder, what you have to do for this week, we have a LinkedIn Learning Certificate. So what that means, Miss Mac, is we're going to go to week 7. We're going to select only engage and explore, okay?
Okay.
and we're going to access it right through there. We're not going to do,
Okay.
we ain't going to try to get it through the grade book. We ain't going to get it through nothing else. Just only
Gotcha.
through here, okay?
Okay.
Just keep it simple. Keep it simple.
If I mess up, I'll be emailing you. You know I
Hey,
will.
you know, that's fine. I'll be here to help you.
Okay.
So make sure, just as you did before, make sure all the green check mark appears to all the videos. Go in order. Just let it play through. You know, this should take you probably about an hour, hour and a half. Not too bad, right?
I don't believe you. Don't
Okay.
believe you.
All right. You'll get to the very end, just like you've done before. As soon as it gets to the very end, it'll read like this. It'll say, congratulations. It'll say your name. And then you'll go down here to the certificate, click on Show All, click on LinkedIn Learning Certificate, and then click Download PDF Copy. PDF Copy downloads to your machine. You come back to the classroom, and you'll upload that PDF right here. You'll drop it in, click Submit. It comes to me, and then I'll grade it. That's all you got to do. Nice and easy. And then, of course, we have the Chapter 7 quiz related to accounting information systems. So those are the 2 action items I have for you for this week. They're both due by Sunday night. As we talked about earlier on, you know, as Joy and I were talking a little bit, If you just so happen to have fallen behind a little bit, it's fine. Don't worry. Don't worry. You know Dr. B is always going to take care of you. So just make sure that whatever you missed, whatever you're late with, you do it and submit it. Okay? Because I'll still give you credit. I want you to do well in this course. And the way you do well in this course is by doing all the work. So please, just, do everything you can. Let's get it together and let's get it in. And it'll make for an excellent rest of the course. If you have any comments, questions, or concerns, you can always reach out to me. I'm going to be here for you, okay? I haven't lost a patient yet, so, reach out to me, okay? Thank you so much for your time today. I appreciate all of you being here, and I hope you have a wonderful, awesome rest of your night. Thank you so much. Take care. Good night. Bye-bye.
Thank you, Dr.
Good night.
B.
Good night,
Good
Dr.